Joining us for more is Lance Roberts, CEO and Chief Economist at Street Talk Advisors, and Stephen Englander, Global Head of G10 FX Strategy at Citi. Welcome to you both. Lance, what do you do?
Well, the issue here becomes whether or not that they can get Germany to come along with their program. So let's say that Mario comes out today, lays out an absolute, crystal plan here about using an LTRO financing plan or using the EFSF and the ESM. The problem is ultimately is that Germany's the paymaster here. And Schäuble's been very clear over the last few days that there is going to be no banking license for the ESM at this point. There's really no intention at this point to go forward with the ESM until September when they have their initial vote. So the problem is that for Draghi, he can come out and make a roadmap. The question is whether or not he can follow through with it. And I think that really kind of leaves the markets at some angst over the next couple of months.
Well, Lance, we have a viewer writing in to say Draghi has probably been more successful at moving the general German popular vote towards leaving the common currency than anything else, which ultimately would undercut Angela Merkel's own objective. Is that the real risk here, that if anything, popular sentiment has really turned away from this project?
Well, yeah, it has. And even Kelly, earlier you were talking about Angela Merkel's popularity in Germany. Recent polls have even shown that her popularity has slipped here recently, and she's up for a re-election here soon. So she's going to be a little, and with Germany now slipping towards recession and, Germany kind of facing its own troubles here at this point economically, I think there's going to be more of a pushback from Germany to protect their own at this point rather than trying to go forward and continue to bail out broke countries that really can't afford to pay them back if they do loan them money.
All right, Lance and Stephen, thanks for that. We'll be back with you both for more in just a bit. Still with us are Lance Roberts, CEO and Chief Economist at Street Talk Advisors, and Stephen Englander, Global Head of G10 FX Strategy at Citigroup. Lance, first out to you, we're talking about Spain, just its vulnerability here, the potential for a bailout and its borrowing costs rising. What specifically does the ECB need to do to finally get ahead of this issue, if it even can?
Well, I think the last part of your statement is the most important part, which is that these bailouts that we've seen do. Let's go back and talk about the LTROs for a moment. We can talk about the bond buying programs. They provide a temporary measure of relief. But ultimately, until you start to resolve the underlying debt issues and the underlying economic growth issues, it's going to be very, very difficult to get ahead of this simply by trying just to move debt from one side of the balance sheet to another and kind of shuffle things around the Eurozone. At some point, these economies have to start to turn themselves around organically, get back onto a path of growth, start bringing in some of these debt liabilities that they've got, reduce their interest costs so that the economies can actually begin to grow.
Lance, while we've got you, I just want to pivot real quick and talk about some of the trading action that we saw in the U.S. yesterday. How significant is this disruption, and what is it going to mean, do you think, for equity activity going forward?
Capital yesterday, which is important, this is reminiscent, obviously, of the flash crash back in 2010, is that the problems when you actually start to allow computers to trade, these are man-made programs, they're prone to error. This is going to happen again. The question is ultimately is how much does this erode investor confidence in the markets itself? The one thing that we've seen over the last 3 years is a continued flight out of equities and into fixed income for safety. We have a massive number of individuals, 75 million boomers, moving into retirement that are dependent upon their money, and they're losing faith in that the markets are, quote unquote, a fair place to invest in. In other words, the landscape has shifted away from a environment of fairness and competitiveness to something that seems to be almost rigged in a lot of situations for the individual investor again. And that's what we're really speaking from. In order to have a strong capital market, the one thing that made the United States so great for so many years is that we had a strong constitution, we had strong contract law, and we had the ability to compete on a fair and equitable basis. All three of those have been under attack over the last 3 years by both the administration as well as the financial markets and Wall Street itself. So until we begin to move back towards a situation where the average investor can now feel like they're being able to play on a fair playing field, it's going to be difficult to get that confidence back into the markets.